London property. Is it a global safe haven for your money, or is it just a trap for an investor who doesn't know what they're doing? Well, today we're going to find out if buying to let in one of the world's priciest cities actually makes any financial sense. Let's jump right in.
This is the dream, right? You buy a flat, you get a tenant in there, and you just sit back and watch the rent payments roll into your bank account. Easy, passive income. But when we're talking about London, the reality is, well, it's a whole lot more complicated. And as you're about to see, it might not be the dream you think it is.
Okay, so right off the bat, here's something that might surprise you. When we look at rental yield, and that's basically just the annual rent you get as a percentage of what the property is worth, London actually kind of sucks. The average yield is only about 5.7%, while other big UK cities can easily get you over 7.5%. So if you're just chasing that high monthly income, London is already starting on the back foot.
To really wrap our heads around this, we've got to get our hands dirty. Let's forget the averages for a second and look at a real-world deal. We're going to break down the finances of a pretty typical London buy-to-let, number by painful number.
So let's imagine we're buying a modern one-bedroom flat. We're not talking about some super posh place in Kensington here. No. We're talking about a realistic investment in an up-and-coming area, places like Woolwich or Croydon, somewhere you'd actually expect to find decent value.
And right away, we hit our first huge number. The purchase price for our little one-bed apartment is a whopping £450,000. This single number is the foundation for everything that comes next. Now, for a lot of people, investing, especially if you're coming from overseas, the banks are going to want a pretty big deposit. We're talking 35%, typically. That means you need over £150,000 in cold, hard cash just to get your foot in the door.
But it doesn't stop there. Not even close. Once you add in the stamp duty tax, which is significant, plus all your legal costs and mortgage fees, your total upfront cash investment absolutely balloons to nearly £190,000. That is the real cost of entry.
So you've just put down a massive pile of cash. Now comes the reward, right? That sweet monthly income? Well, let's see how that actually stacks up, because this is where the whole traditional logic of buy-to-let really starts to fall apart in London.
Okay, let's follow the money. The property brings in a pretty healthy £1,950 in rent. Great start. But then the costs start eating it away. First, the mortgage interest takes out a huge chunk. Then the letting agent, of course, they take their 12% cut. And then there's the big one for London apartments, the service charge. This can be a real silent killer of profits. You add a little bit for maintenance just in case, and suddenly...
And what's left over? £99 a month. That's it. After putting down nearly £190,000 of your own money, your reward is less than £100. I mean, on the surface, this looks completely and utterly insane. And that brings us to the most important question of all. This is the exact point where most people would just walk away, thinking London property is a terrible, terrible investment. But what they're doing is missing the bigger picture. They're playing the wrong game entirely. Okay, this is where we have to shift our entire perspective. We need to stop thinking about monthly income and start thinking like the savvy global investors who've been using London property for decades. It's time to look at the real London wealth blueprint. This is the absolute core idea. You don't buy a property in London for spending money. You buy it to build and to preserve your wealth over the long haul. The rent's main job isn't to make you rich every month. Its job is to cover the mortgage so that someone else, your tenant, is basically paying off your asset for you. This slide really lays it all out. You've got two different mindsets. The beginner sees that tiny £99 profit and runs for the hills, but the experienced investor, they barely even look at that number. They are focused on the other return, the growth in the value of the £450,000 asset itself. At a pretty conservative 5% a year, that's over £22,000 in growth. We can call this the London factor. It's the sheer power of long-term capital growth. That's the property's value going up over time. Historically, this has averaged around 5% per year in London. And what's amazing is that this growth is amplified by leverage, because you get the appreciation on the entire £450,000 asset, not just on the cash you put in. So let's recalculate our return, but the smart way this time. First, we take our small annual cash flow, about £1,200. Then we add the capital growth. 5% of the property's value is £22,500. That gives us a total annual return of almost £24,000. Now we just divide that by our initial cash investment. And there you have it, a true annual return on your investment of 12.5%. All of a sudden, that bad investment is actually outperforming the stock market. See, you're not just making £99 a month, you're generating significant wealth through asset growth. That is the London strategy.
Okay, so now that we get the strategy, how can you actually put this into practice? Let's quickly go over a few key rules that'll help you find the right kind of deal in this pretty unique market.
Now, just a quick word of caution. Just because capital growth is the main prize, it doesn't mean you should be happy to lose money every single month. The sweet spot, the ideal property, is one that balances that strong growth potential with at least break-even or maybe even slightly positive cash flow. You can, and you absolutely should, try to optimize for this.
Here are a few quick tips to help you find a better deal. Try to aim for a gross yield over 6% if you can. That gives you a nice buffer. Always, always investigate those service charges. I'm telling you, they're the silent killer of profits. Look for better value in the outer zones, zone 4 and beyond. And maybe consider some clever strategies like using an interest-only mortgage just to help your monthly numbers look better.
So at the end of the day, it all comes down to this. There's no right or wrong answer here, but you have to know which game you're actually playing. Are you looking for income to spend today, or are you trying to build a foundation for serious wealth tomorrow? Your answer to that one question will determine if London is the right market for you.